HALT everything. Small silver investors must see this. Right now, in the last few weeks, something happened in the silver market that most people will not understand until it's already too late. Nearly 100 million ounces disappeared from the system, not traded, not rolled, not shuffled on paper, delivered, taken, removed. When metal gets pulled out at that speed, it's not just a trade anymore. It's a message. And the question nobody's asking is, who is sending it? Governments, industrial giants, or someone who knows something the public won't understand until the shelves are empty? Because what happens next could force a repricing event that headlines can't ignore. Welcome to John Analyst. Now, before we dive deeper into what this delivery surge really means, I need to ask you something important. If you've been around long enough to remember when handshakes meant more than contracts, when your word was your bond, then you understand the value of straight talk. That's what we do here. No hype, no shortcuts, just the kind of analysis that helps you see what's coming before the crowd does. So if you appreciate that kind of work, do me a favor, hit that subscribe button right now, because this channel survives on people like you, people who value depth over noise. And while you're at it, drop a comment and tell me, where in the world are you watching this from? Are you watching from the States, Europe, Asia, somewhere else entirely? I'm curious, because what's happening in silver, it's not just an American story, it's a global shift. And I want to know, who's paying attention early? All right, let's get into it. Most people think silver is just a price chart, up one day, down the next. Maybe a little hype, maybe a little fear. But the real silver market isn't the chart. The real market is the flow of physical ounces, from the hands of sellers to the hands of buyers. And the moment the biggest buyers start demanding delivery instead of playing the paper game, the entire illusion gets stressed. Because the futures system only works smoothly as long as most contracts never end in delivery. They get rolled forward, closed out, netted, offset. That's normal. That's the engine. But when people show up and say, no, I don't want the paper, I want the metal, it's like walking into a bank and asking for a mountain of cash while everyone else is still swiping plastic. And the numbers they're seeing right now are not normal. One recent month saw close to 70 million ounces stood for delivery. Then, in a non-major delivery month, the market still saw tens of millions more, within days, within a week. That's the part that should make eyebrows go up, because minor months are supposed to be quiet. They're supposed to be the months when the system breathes. Instead, it's acting like someone is pulling oxygen out of the room. Now, who is doing this? That's the question that turns this from interesting into explosive, because retail stackers, even when they're motivated, don't show up and stand for delivery of 38 million ounces in a week. That's not a couple of guys buying tubes of coins. That's not even a big dealer restocking inventory. That's a scale that belongs to institutions, governments, mega-industrials, or all of them working in parallel. And when analysts ask who would want that much silver right now, and why, the list gets short and uncomfortable. Maybe it's a government, maybe it's an industrial giant, maybe it's a consortium, maybe it's someone who knows something about future supply constraints that the public won't understand until the shelves are empty. And the scarier possibility is that it's not one buyer at all, but multiple buyers who are all reacting to the same set of signals. Because in markets like this, what observers often witness is not one player making a move. They witness a stampede of informed players, repositioning before the story becomes mainstream. And that brings analysts to the next part. The mainstream financial media is whispering about rebalancing and technical flows and normal volatility, as if this is just another season in the markets. But those who have watched this space long enough recognize the pattern. When real pressure builds under the surface, headlines get loud about the wrong thing. They'll talk about a chart pattern. They'll talk about speculative mania. They'll talk about how investors should take profits before they lose it all. But they won't talk about the one metric that matters. Who is removing the metal? Because that conversation leads straight into the uncomfortable question. What happens if the exchange can't meet delivery demands at the pace the buyers are demanding? Now, market observers aren't saying the system collapses tomorrow. They're saying the system becomes vulnerable when it is forced to do the one thing it was designed to minimize, deliver. And to understand why, they need to talk about rehypothecation. Rehypothecation is a fancy word for a simple problem. The same underlying asset gets promised multiple times. Think of it like a parking space that is rented out to 5 different drivers, because the landlord assumes most of them won't show up at the same time. It works until it doesn't. In paper markets, the same ounce can be represented by layers of claims, futures contracts, ETFs, synthetic products, swaps, options. It creates the appearance of abundance. It creates volume. It creates liquidity. It creates fees. And it creates an entire ecosystem where people trade silver without ever touching silver. But the weakness of the system is obvious. If too many people demand the real metal at once, the paper promises get exposed. That's why the best comparison isn't a normal market. It's a redemption event. It's like a fund that promises daily liquidity while holding liquid assets. It's fine while everyone is calm, but when people rush to redeem, they find out what's real and what's just accounting. And that's why the analogy to famous financial frauds works so well. Everyone was happy while the checks kept coming until they asked for the principal back. Then the whole thing had to reveal itself. The silver market has a similar vulnerability. It can manage paper flows, but physical flows are a different animal. So why now? Why is this happening now? Something shifted in the language governments use when they talk about silver. And most people missed it entirely because it didn't come with a press conference or a dramatic announcement. It came quietly, buried in policy documents, regulatory updates, and strategic materials lists. Silver was flagged as a critical material, not because it's shiny, not because it's a collector's item, but because it's essential. Essential for electronics, essential for solar panels, essential for military systems, essential for the industrial backbone that modern nations can't function without. And once a material is labeled critical, everything changes. It stops being viewed as a commodity and starts being treated as a strategic input. That's a different mindset entirely. That's the mindset where governments start thinking in stockpiles, domestic needs, and supply security. And while the public debates whether silver is too volatile, the big players are asking a completely different question. Can they secure what they need as before everyone else does? Now, layer on top of that the reality that a massive share of global silver refining capacity sits in a small number of hands. When the major refiners tighten export rules or prioritize domestic needs, the global supply people talk about becomes less global very quickly. And here's the part people don't like to admit. When a country refines a huge portion of the world's silver, they don't need to ban anyone from buying it. They just need to slow down the faucet. A small policy change can create a large downstream shortage. So when observers see massive delivery demands on an exchange, at the same time, policy signals are shifting toward prioritizing domestic needs. That's not random. That's a pattern. It suggests the big buyers are positioning for a future where available silver is not the same thing as silver that exists somewhere in the world, because silver that's in a vault in one country is not the same thing as silver that's accessible to global industry. Now, let's talk about scale, because people hear 100 million ounces and it feels abstract. Let's make it physical. A monster box of popular silver coins is heavy, very heavy. Multiply that by thousands, multiply that by tens of thousands. Now they're talking about logistics, security, warehousing, and strategic planning. Nobody does that casually. And that's why the next question is the one analysts have to ask, even if it makes people uncomfortable. Is a government involved? Market watchers aren't claiming they know for certain, but they're pointing out the behavior matches exactly what one would expect if a government was quietly building or replenishing a strategic stockpile. And before someone says, why would they do it in the open market? Remember, standing for delivery is legal. It's how the system is designed. If an entity has the capital and wants the metal, they can do it. And if it's a government agency or a connected institution, they might prefer to do it through mechanisms that look normal on paper, even if the scale is extraordinary. Now, industrial giants enter the picture too, because the industrial side of silver demand is not a theory. It's not a maybe. It's a real pipeline of usage that keeps expanding. When a company that depends on silver for manufacturing begins securing supply directly from producers, it's not because they want to speculate, it's because they fear supply disruption. And analysts have already seen the blueprint for how that works. Instead of buying on the open market and hoping the supply is there, major buyers go directly to producers. They buy ore or concentrate and lock it down. They pay up, they secure the feedstock, they send it to their own refining channels. They remove middleman risk. That is not the behavior of a market that thinks silver will be plentiful forever. It is the behavior of a market that thinks the next shortage could be a national problem. Now here's where it gets particularly revealing. When industrial buyers start to panic, they don't buy a little more, and they front load, they stockpile, they say, if I need this for the next 5 years, and I'm not sure it will be there, I'd rather hold too much than too little. Because running out of silver isn't like running out of paper clips. It can shut down production lines. It can halt contracts. It can become a reputational disaster. And this is how the battle sets up. On one side, industrial demand that is non-negotiable. They need silver to operate. On another side, investors who see silver repricing and they want exposure. On another side, governments who see silver as strategic and they want supply security. And then finally, retail investors who show up last, paying the highest premiums, fighting for scraps. That's not dramatic language. That's how commodity cycles usually work. The easy supply gets spoken for before the public understands what's happening. And if observers want one of the simplest signals that silver is not a normal commodity, it's this. A surprisingly small portion of mined silver comes from primary silver miners. A huge share comes as a byproduct of mining other metals. That matters because byproduct supply doesn't respond quickly to higher silver prices. If silver doubles, copper miners don't instantly double copper production just to get more byproduct silver. The supply curve is rigid, so when demand rises and supply is rigid, the pressure doesn't release gently. It builds, and then it snaps into a new price regime. There's a narrative that keeps getting repeated in financial media. The dollar is strong. They point to the dollar index. They show charts. They cite central bank policy. And on the surface, it looks convincing. But here's what they're not telling anyone. That's like saying a person is healthy because they're taller than the sickest people in the room. The dollar index measures the dollar against other fiat currencies that are also being devalued. It's not a true yardstick of purchasing power. It's a relative measurement in a race to the bottom. A better measurement, a more honest measurement, is this: what can those dollars actually buy? And when analysts measure dollars against gold and silver, the story changes completely. Because what has happened over the last couple of decades is that assets priced in dollars look like they're going up, but assets priced in gold often look like they're coming down. That sounds crazy until someone does the math. Let's use a simple example. 20 years ago, the average house price in the United States was in the low 200s. Gold was in the mid 400s. In that world, it took a little over 500 ounces of gold to buy an average house. Fast forward to today, yes, house prices are much higher in dollar terms, but gold is also dramatically higher. And when economists compute the purchasing power, those same ounces of gold can buy multiple houses today, not one, which means the house price didn't go up as much as the currency fell. This is the part most people struggle to accept. The currency is the thing that is changing. The unit of account is the thing that is melting. So when someone hears silver is going up, a smarter framing is often the dollar is going down and silver is showing the truth. And that matters because if the system is built on perpetual currency dilution, then hard assets don't need to win. They just need to remain hard while the money remains soft. Now, analysts can already hear the question forming. Okay, but what does that mean for small investors? Here's what it means. Small silver investors can't outbid governments. They can't outmuscle industrial giants. They can't outleverage hedge funds. But they can pay attention early. They can understand the difference between paper narratives and physical signals. They can stop letting mainstream headlines scare them out of positions. At the exact moments when physical accumulation is accelerating, they can think like risk managers, not like gamblers, and they can avoid the trap that kills most people, waiting for confirmation from the same outlets that ignored the signals. Because once the mainstream starts screaming about silver, it won't be because it's safe. It will be because it's obvious. And when it becomes obvious, it becomes expensive. Now, let's talk about positioning, because this is where ownership behavior reveals everything. Price is the public scoreboard. Ownership is the private strategy. And right now, ownership behavior is screaming. Because if the biggest money in the world is moving billions into physical acquisition month after month, observers have to ask, what do they know that the public doesn't? They might know about future demand. They might know about future supply disruptions. They might know about policy changes. They might know about refining bottlenecks. They might know about hidden short exposure that can't be managed if delivery pressure continues. They might know that the paper silver market is far more fragile than people assume. Or they might simply know that in a world where currencies lose purchasing power, hard assets are the lifeboats. Now, here's where the mechanics get dangerous. In markets like this, short exposure is the silent killer. If large players are naked, short, they are effectively betting they can source metal cheaply later, or that they can settle in cash, or that nobody will demand delivery at scale. But when delivery demand spikes, the shorts lose control of the timeline. And timeline risk is brutal, because a short position can survive price moves if they have time to manage it, but a short can die if they are forced to deliver something they can't source quickly. This is where whispers start circulating, that some banks flipped positions, that the exposure moved, that certain regions are more vulnerable than others. Analysts aren't here to name names from someone else's script. They're here to explain the dynamic. When the smart money changes sides, it's usually because the risk has become asymmetric. And in silver, asymmetry is the whole story. The downside is limited by real-world industrial demand and scarcity. The upside is amplified by the paper structure and the potential for a scramble. That's why observers see periods where silver does nothing for months, and then moves in violent steps. It's not a smooth asset. It's a pressure cooker. Now, let's talk about the ratio conversation, because it's one of the simplest ways to see the distortion. Silver is mined at a much smaller ratio to gold than it is priced. That alone should make people pause. Then add the fact that silver gets consumed and not recycled at high rates, because it's used in tiny amounts in millions of devices. Gold mostly sits, silver disappears. That changes the supply picture over decades. So if the market begins to regress toward historical ratios, or even toward more reasonable ratios, it implies that silver has a lot of room to move relative to gold, and the move doesn't need to be perfectly logical in the short term. It just needs to reflect the growing scarcity and the growing strategic demand. Now, here's what analysts are watching closely. The biggest risk for the paper-silver market is not price, it's delivery. Price can be managed with narratives, leverage, and liquidity games. Delivery forces reality, and reality is hard to negotiate with. Most people look at markets and see prices moving, but the real story is happening in the plumbing. And right now, the plumbing is under pressure. On the exchange, inventory isn't just one pile sitting somewhere. There's the metal that's effectively ready to deliver, registered. And there's metal that's stored, but not committed unless an owner chooses to make it available. Eligible? Think of it like a store shelf versus a warehouse. When delivery requests surge, the shelf empties first, then the market has to coax metal from the warehouse to the shelf, and that's where stress starts. Not because silver doesn't exist somewhere, but because deliverable silver at a specific place, on a specific timeline, is a different question entirely. That's the timing problem, and timing problems are what break paper systems. Because paper systems are built on confidence that settlement will occur smoothly. They can look fine for years, and then wobble in a single week. If too many participants demand the underlying asset at the same time, that's why delivery pressure matters more than price action. Price can be pushed around with leverage, headlines, and risk-on risk-off narratives. Delivery forces reality. Now, here's something observers should sit with. What if these buyers aren't chasing profit, but chasing insurance? If a buyer's goal is insurance, a $5 dip doesn't scare them. It motivates them. They don't care about next Friday's candle. They care about securing metal before access tightens. And that's exactly what strategic behavior looks like. Persistent, calendar agnostic, accumulation, which brings analysts back to deficits. A structural deficit means the world is consuming more silver than it produces, year after year. That can be masked for a long time by above-ground inventory. But every year of deficit quietly drains the cushion. The thinner that cushion gets, the more sensitive the market becomes to shocks, a mine disruption, a refinery bottleneck, a policy change, a surge in industrial demand, and silver is uniquely vulnerable here because so much of its supply is byproduct supply. If base metal mining slows, silver output can fall. Even if silver demand rises, that's the kind of feedback loop that turns tight into scarce without warning. Now, if someone wants a street-level truth signal that doesn't require a trading terminal, pay attention to physical availability and premiums. Paper price can look calm while the real market is straining because premiums reflect replacement cost and supply tightness in the real world. And this is why the critical material language matters so much. Once a commodity becomes strategic, it stops being treated like a normal commodity. Countries don't just buy it, they protect it. They prioritize domestic needs. They tighten exports. They shift from sell to the world, to secure for ourselves. That's not a conspiracy. That's what nations do. When something becomes essential to security and industry. Now, analysts also need to say this clearly. Retail is almost always last. Not because retail is unintelligent, but because retail gets fed the story late. Retail gets trained by headlines. When price rises, they get told it's too late. And when price drops, they get told it's going to zero. And when the real signals show up, they get distracted with noise. If someone wants to break that cycle, follow flows, not feelings. Deliveries are flow. Direct mine sourcing is flow. Export tightening is flow. And the flow right now is pointing in one direction. Physical control. Now, about the battle scenario. Because this is where things can get violent. Industrial buyers can delay purchases for a bit, but they can't stop needing silver. They can't redesign the global electronics and energy stack overnight. So when industrial procurement collides with persistent investment demand, markets don't get polite, they get bidding wars, and bidding wars don't care about anyone's comfort zone, they care about clearing price. Picture it like this. One major manufacturer decides to secure a year of feedstock, just in case. That drains supply. Another manufacturer notices and does the same. Then the sector starts front-running the future, because nobody wants to be the last buyer in a tight market. At the same time, funds chase performance, and then retail piles in. When the story finally becomes obvious, that sequence doesn't end with gentle corrections, it ends with repricing. Now, analysts aren't asking anyone to predict the exact day. They're asking people to recognize the direction of pressure, and the pressure is moving toward ownership, security, and removal of counterparty risk. That's why the biggest players are not just trading the story, they're taking the metal. So here's what observers are watching like hawks. They're still early in this delivery window. There's time left for more contracts to stand, and that matters because the market usually cools off after the first rush. If the pace stays elevated instead of fading, it tells analysts this is not a one-off event, it's a campaign. Watch how quickly deliverable inventory refills after large stops. If it refills instantly, the system is comfortable. If it refills slowly, the system is negotiating. And if anyone starts seeing unusual incentives, unusual spreads, or chatter about alternative settlement, that's the market admitting stress. Without using the word stress, also, watch what happens when the next major month approaches. Big players often position early, and if they're willing to pull metal in smaller months, imagine what they'll do when the calendar gives them the bigger stage. This is why market observers keep emphasizing, don't get hypnotized by a single red day or green day. In a repricing story, volatility is the tax someone pays for being early. And yes, some people want the perfect entry, but perfection is usually a disguise for procrastination. The better approach is a plan. Scale in, manage exposure, and keep dry powder, so no one is forced to sell when the crowd gets scared. Now, here's the near-term sequence analysts expect. First comes the quiet accumulation. That's where the market is now. Then comes the visible strain, where physical premiums spike and delivery delays surface. Then comes the public stampede, when headlines finally catch up. And then comes the regret of everyone who waited for confirmation. Because the silver market isn't just moving, it's being restructured. And restructuring doesn't announce itself with fireworks. It announces itself with delivery data, policy shifts, and flow patterns, the kind of signals that most people ignore until it's already repriced. So the question isn't whether silver will move. The question is who will be positioned when it does.